So let's now come to the topic of discussion, big lessons from Reliance new trade. So what is this new trade? Reliance basically is looking to exit its investment in Asian Paints. So Reliance made an investment in Asian Paints way back in 2008, and it holds 4.9% in Asian Paints. And this acquisition was made for 500 crores uh, in 2008, almost 17 years back. And today it is valued at 11,000 crores, about 24x has gone by. And Reliance is now wanting to exit after getting frustrated with last 3.5 years in Asian Paints. So we are going to discuss, the trade as well as what lessons we can draw from it. So why potentially Reliance is selling off is because of changing landscape in paint. So margins have been under pressure despite falling raw material costs, and there has been intense competition with new companies entering the paint segment, mainly Grasim. And Asian Paints market share continues to fall from 59%. It has fallen to 52%. And Berger and Kansai has have been the other participants in the paint market have been doing well, and and sort of taking lead on to Asian Paints in terms of growth. So what has triggered Reliance exit? So stock has fallen 19% in the past 1 year. So 51,000 crores of values got erased. Reliance is likely concerned about the erosion of dominance of Asian Paints, the shrinking margins at Asian Paints, and the slowing revenue of Asian Paints. And the paint market is shifting very, very rapidly, and the moat that used to be there for Asian Paints seems to be under attack. Asian Paints, of course, has been a stellar long-term wealth creator. There is no two ways about it. The way the stock rose from virtually from 2009, you can say, uh, and in the last 25 years, a 30,000% growth has happened in Asian Paints. When in the same time period, Nifty was up 2,400%. So you can see what kind of a magnitude difference versus the market Asian Paints has been able to deliver. However, there is a time for remaining invested in a stock, and there's a time to be exiting in the stock. When the going is good, you want to be invested, but when the going is not so good, you should definitely review your decisions. So painful last 3.5 years for Asian Paints. This is there in the chart here. Asian Paints has clocked negative 34% in this time period. Although Kansai Narolac is also down 33%, Berger Paints is also down 16%. But Asian Paints, being Asian Paints, the expectations is very, very high in terms of the delivery. And in the same time period, Nifty is up 38%, while Asian Paints is down 34%. So the kind of opportunity cost loss is mind-boggling. And Grasim, which is yet to sort of fully immerse in the paint industry. However, that stock has run up ahead of its paint business getting established. And that stock is up 54%. Some of it may be due to other reasons also, but reasonably you can see that there was a shift of market share even before the market share has gone there. So the price of stocks will discount a lot of things ahead of before them actually happening. So what lessons can we derive out of this story, and how being a non-discretionary investor could help you with most of the ambiguity? A lot of folks, I'm sure, uh, have to deal with this decision making on a day-to-day basis. This is only one example that we are taking of Asian Paints, and that too by a you can say an institutional investor who had potentially no need for the money, and probably could have waited much longer without any problem. But the problem that most retail investors face is this decision making, is how to go about it. So this emotional attachment to past winners is the key reason why a lot of folks will not sell a good stock that has perhaps passed its glory for now, uh, and continue to hope that that stock will continue to do well. If you look at the last 30 years, uh, the constituents of Sensex have changed dramatically. If you look at S&P 500, if you look at Nifty, constituents will change all the time. There is a disruptive world out there. There will be other competitors who will come into the marketplace, who will take away your moat, and market will discount it much ahead of it actually happening on ground. So legendary stocks that are there find it very difficult to keep themselves, you know, in the legendary with the legendary tag. They have to continuously innovate. They have to continuously stay ahead of the market to do that. Sometimes they are able to do, many times they're not able to do. But the legendary status sticks with them, and investors continue to sort of hope against hope. Uh, and in this example, I'm certainly not painting a picture that Asian Paints is no good a stock anymore. I do not know. But what I'm trying to tell you is that these decisions become very, very difficult when you are in a discretionary mode of investing. Non-discretionary, for instance, the way momentum investing is done, doesn't wait for confirmation calls or press releases. Basically, it exits when the trend weakens and simply gives you a very non-guilt based decision point. When you are selling a stock which was perhaps bought because of your own decision, and now you are selling it, and tomorrow, 2 years later, Asian Paints is again the market leader for whatever reason, you will be saddled with a lot of guilt that why did I sell it. So this entire thesis of having a system tell you when to buy and when to sell actually eases things for yourself, and you are able to take clear cut decisions. So winners will change all the time. Today, it may be Grasim. Yesterday, perhaps it was Asian Paints. Tomorrow, it may be Kansai. I don't know how that change will happen. But the last 3.5 years were some tremendous years in the market. And at that point of time, we lost 38%. So this potential about the opportunity that has gone by, that needs to be priced in into your equation. Stock has gone nowhere. In fact, stock has gone negative, while the rest of the market has gone bonkers. I mean, if the same money was invested in some other sector, some other stock, perhaps you could have been at a different cloud. Now, uh, not assuming that past winners will always, sort of lead ahead. That is the key for in unbiased selection. Wherever strength is building, you want to be there. So today, if defense is building strength again, you want to be there. Because momentum or any other strategy that is built like momentum will adapt to the changes that are happening in the market. But because we are saddled with a lot of emotional baggage when we do discretionary investing, we are not able to adapt. Even if the brain is telling you that you know you need to switch, it's a difficult switch. It's a very difficult switch because in the past that stock has performed for you, and now you have a emotional tie with it. It's almost like breaking a marriage that was so good so far, but if it is not good today, I mean, your future could be in trouble. So winners will change continuously. Any index that you see, you will see winners of the past decades. Very few will carry on to the next decade. It will be sometimes a new sector, it will be sometimes a new stock. You will need to adapt with those changes, and change is that only constant. So opportunity cost is real, even for a company like Reliance. Reliance, although has made an impressive 24x in 17 years, but still lost some opportunity cost. And that's probably a decision making that they also have done over some period of time. That you know the market is not rewarding us for where we are in terms of our investment, and perhaps we should take it. We have made a significant amount of money. Perhaps we should get out. Now, it is not that mistakes are made only by retail investors. All institutional investors, all corporate investors, all kinds of investors go through the same emotional roller coasters. The only difference being that you are there by yourself, and they may have an investment committee, and then a consensus may have to happen between a few people to pull that plugs. But other than that, every human mind is subject to the same biases, same emotions, and professional investors, due to them being professionals, perhaps can be take better decisions in terms of controlling emotions. Now, if you see, in 2008, Reliance bought this company stake at the highest point of Asian Paints then. I mean, the stock had gone from, I think, 40 rupees to 80 rupees, and Reliance bought it in FOMO at that point of time. Yes, Reliance is very lucky that it has made 24x. But if you ask me, the decision to buy Asian Paints after 4 or 5 years of it running from 20 rupees to 80 rupees, not such a good decision. And then immediately on buying that, for in the next 1 year, that particular stock collapsed about 50% from there. And then of course, luck as luck would have it, they had it very nice. And basically they're trying to exit Asian Paint. The pointer says exits, but it is going to exit. They're looking for a buyer, so don't know yet at what point they will find a buyer. Now, this is typical of retail investors who enter at tops in FOMO and exit at bottoms out of panic. But what good the professional investor here has done is that they did not panic in 2008, and they continued to hold. Maybe this was just a minor investment for them in their large book of investments. That perhaps can also make a difference in terms of how edgy you are in terms of when the stock goes up or down. So the pill for retail investors basically is, if it's based on exit, to be based on price trends and rule based if it is non-discretionary. Otherwise, it is gut feel, conviction, news, watching others. Uh, I know a lot of folks who are invested in Asian Paints since a long time, and they made good money. No doubt about it. But the last 3 4 years, they have been confused. They are thinking, and maybe if such a large investor is making an exit, perhaps a lot more people will join in terms of thinking that if that investor is selling, I might sell as well. That kind of a group think may happen. So attachment to stock happens. I know this company. I know this company can do well. I know this company in the last 20 years is able to innovate. That kind of a emotion will overpower you. In non-discretionary system, it's all data, no emotions. You basically get out when you have to get out. A lot of waiting and hoping happens in discretionary. Sometimes it helps also, and in your non-discretionary, basically you exit when the trend weakens. So just to also make sure everybody understands this, discretionary is making investing is basically when you as an individual is making the decision, and the entire decision is based on your discretion. That today if you want, you can buy it. Tomorrow if you want, you can sell it. Non-discretionary is basically following some rules, some frameworks, and that when that framework says buy, you will buy. When the framework says sell, you'll sell. Your emotional decision is not coming in the middle. And new leadership recognition, like it is happening now, often delayed to actually see it on ground, and hence perhaps gets delayed in the decision making. Whereas in non-discretionary, as soon as trends start to change, momentum is going to switch, and the outcome perhaps could be that often we hold more for more time than required, perhaps at times. Sometimes it helps as well, but a lot of times we hold on to losers for too long. In non-discretionary systems, you will basically ride the trend and cut the laggards when you have to. So this is the discussion on this one trade that Reliance has done. It has done well, no doubt about it, but not all trades go as well. Uh, they could have perhaps entered the stock and the stock never went up. That kind of a thing would have happened in the last 6 months to many folks. So have you delayed your exit on any stock? Have you entered out of FOMO and regretted the decision later? I think this happens to almost everybody. Do let us know in the comments, and let us know if these learnings are of any use going forward for you. Thank you so much for watching. Do like and share these videos, and do subscribe to the channel. Thanks. Bye.